On Business Incorporated today, Senegal gets €121 million loan for emergency fund production. In Nigeria's Eurobond trade at worst price in years as dollar scarcity persists. Now, Egypt set to launch a low-cost airline, Airfins. Hello and welcome to the program. Let's start with a look at equities in Africa, where major indexes are closed for the Muslim holiday, except for South Africa. In Nigeria, the NGX had a tumultuous week last week. Closed on Friday, it was down at 0.01%, while South Africa's JSE was trading marginally lower by 1.14% at intraday. Elsewhere, Egypt's benchmark index closed higher on Thursday, up by 1.09%, while the Nairobi Stock Exchange closed Thursday in the green. Heading to the Middle East, where markets are also closed for the Eid al-Kabir celebrations, closing on Thursday in the United Arab Emirates. The Abu Dhabi index was down 0.3%, while Dubai's exchange was up 1.54%. Saudi Arabia closed Wednesday in positive territory, while the Qatari index closed on Thursday at 0.78%. Crossing over to Europe, and we ask, could winter begin this week in Germany? And that's the grim joke here, because as Berlin fears that today's start to the annual maintenance of a key natural gas pipeline run by Russia may be used as a pretext to turn off gas supplies altogether. Let's go now to Stephen Beardsley, who is in Berlin, to tell us how significant this sudden stop in imports could mean for Germany. Hi, Stephen, how are you doing today? Now, how likely is that Russia
running between Russia and Germany is the largest single pipeline delivering natural gas to Germany? There's no way of knowing, frankly, whether it could be turned off, but there's every reason to suggest it in recent days and months, given that this has been an implicit, if not direct, threat made from Russia over the past weeks. Now, there is an annual maintenance time that occurs, of course, every year, and it generally lasts from 10 to 11 days. The fear here that that the pipeline, frankly, won't be turned back on. There is precedence for this, given that Russia has already turned off flows to neighboring countries, and it's reduced flows to Germany as well. And the likelihood has frankly grown in recent weeks as the EU has made clear that it's going to slowly wind itself down from all Russian imports. So there is an incentive for Russia to perhaps keep its leverage as long as it can. Germany saying that it wants to have supplies, reserves, natural gas reserves up to 90% by the beginning of winter. Right now, they're closer to 60%. So at some point, it makes sense that Russia is doing the math and figuring out how it can maintain its leverage at the longest point, possible. We should mention here that, of course, Russia makes a lot of money from these sales as well. So there is an incentive to keep them going. So we don't really know how this could play out, but there is a lot of concern here.
But what would this shut off? What would it mean for the German economy and households in particular?
Yeah, this is the huge question. 55 billion cubic centimeters of gas a year. That's what it delivers to Germany. But of course, a lot of this goes downstream further into the EU. So the effect wouldn't just be within German borders, but across the EU. And that's why you've seen shares across the continent take such a hit over the past months as this fear has grown. Germany is the country with the largest economy that is so heavily reliant on Russian gas. So there's reason to believe that it would be especially affected. Most of that gas goes towards household heating. That could be one area that would be hit, but more than likely that would continue to be the priority in the months ahead, and it would be industry that would really take the hardest hit. A decent amount of electricity is generated through gas. That would be one possibility, is that would fall off and likely have to be replaced by coal. And then gas is a key ingredient for some industrial processes, especially in the chemical and steel branches. And so there's no immediate replacement for it as a raw input, which would mean mean that some of those processes would probably have to be stopped. Some of the production lines would have to be closed down, and then that would have secondary and tertiary effects in the larger ecosystem of these materials and these productions. So that would mean that potentially other industries that rely on these chemicals or on steel, for example, within Germany might then have to reduce their output, and that could have a trickle effect that then brings down the overall economy. And of course, jobs, that means jobs ultimately. That's the big fear here, is what it could look like for jobs, what it could look like for economic output.
So what are we looking at this week for European markets?
Well, those fears over gas will continue to weigh down European markets, especially in Germany, until there's some clarity on what's happening. But we've seen major indexes today starting out in negative territory. In Europe, when we look at Frankfurt, London, Paris, there's another thing bringing it down too, and that is what's happened in Asian markets. The emergence of a new Omicron variant in China and Shanghai in particular is raising concerns that there might be further lockdowns, which would further depress economic output from China. That, of course, has an immediate effect downstream for nations that rely on China as a supplier of key materials. So we're already seeing some fears about that. That's weighing down on Europe as well. For this week, when we look ahead, some of the key things that we're waiting on is an inflation report out of the U.S. on Wednesday that could have broader ramifications for the global economy. And then we're going to see a lot of second quarter earnings this week, and investors will be poring over those numbers to see not only how companies did in the past quarter, but what consumer sentiment looks like and how they project it to look like in the coming months ahead, if they maintain their projections or if they're going to further lower them. And investors will use that as a metric to determine their own fears of recession and how they want to react. So those are the two big things that we're looking for so far, and I'm sure there'll be other smaller numbers that are going to likely rattle and rock the markets or even send them going up.
Thank you, Stephen, for that update. We'll look forward to more reports. Now to the UK, where the boat is still being rocked on every side. Heathrow announced flight cancellations and warns more cuts are possible. Juliana's in London and has the details of that. Hi, Juliana. Now, Juliana, Heathrow Airport has cancelled more than 60 flights today, and it seems like airports are still struggling to meet up with demand.
You're absolutely right. Unfortunately, for tens of thousands of British holidaymakers hoping to get perhaps some winter coolness, some early winter coolness, or some more sun, their travel plans were put into absolute chaos today because Heathrow Airport did announce at the very last minute that they were cancelling over 60 flights. And this isn't the first time. We've been seeing it over the past couple of weeks from airlines which include British Airways, EasyJet. They've all had to cancel because they cannot cope with the unprecedented demand. We know that most, if not all, COVID restrictions across Europe have been lifted. Lots of people who weren't able to get away over the past couple of years have been desperate to try and do so, and the airports just cannot cope. The fact that they haven't got enough staff is what has been dogging them over the past couple of weeks, and according to Heathrow Airport today, it was because they haven't got enough baggage handlers. There have been so many images on social media showing, mountains of bags that have been left abandoned, not enough staff to be able to put them on planes. People have got to their destinations without having any idea when they're going to collect their bags. And this is why we've seen the British government, as well as the Civil Aviation Authority, get involved and ask airlines to try and accommodate passengers. And if they're unable to do so, then cancel flights. And as you quite rightly said, Will, it does appear as if more turbulence is to come because Heathrow Airport, John Holland-Kaye, the CEO, has said this morning that you can expect more delays in the summer. They have said that they're putting out a recruitment drive which started in November to try and get those numbers back in because, of course, so many of them were furloughed and decided they wanted better careers. But it's not great, especially because we are just about in the next couple of days going to hit peak summer season where children come off school and would hopefully look forward to going on a holiday.
Juliana, this doesn't look so good, especially with the economy and rising energy costs. And the UK is also gearing up, in other sectors of the economy to close up regulatory vacuum that we're seeing in the crypto market. How do you think they plan to do that?
Well, we just have to wait and see. The Bank of England's Financial Reporting Committee, Financial Policy Committee, they've appointed Matthew Long as a new advisor to try and get a handle of cryptocurrency regulation. We know that various governments across the world have tried to regulate the market over the past couple of years, but there has been a vacuum, and that's because of the war in Ukraine. Lots of efforts have been put there, but now that the former UK Chancellor Rishi Sunak resigned from his position, I think there are fears within the industry that perhaps his plans, which was to make the UK a hub for crypto, will not come to pass. We've got Nadhim Zahawi as the new Chancellor. He's obviously in the running to become the new Prime Minister. What happens in between that time? I think the concern really is the fact that, crypto has completely plunged, hasn't it, over the past a couple of weeks. This time last year, I think crypto assets were worth about $3 trillion, and now it's worth about $900 billion. Is people's money safe? Particularly, we're not talking about people that store crypto, we're talking about people that use crypto as a way of paying for goods. So the Bank of England have got involved. We're expecting perhaps new announcements in the coming weeks, but I think the fear is, because there's so much focus on the race to become, the housekeeper in number 10, that, focus on really important sectors will go astray.
Speaking of fears, Juliana, COVID worries are hitting again. And how are markets looking at intraday?
Yeah, the markets are not great at intraday, very much red. The FTSE all share is down 0.22%. The FTSE 100, that's down by 0.23%. And the FTSE 250, the domestic market's down by 0.20%. In the currencies market, the British pound is currently trading down against the US dollar by 0.5%, but up against the euro by 0.14%, and up against the same amount by the Japanese yen at intraday, Will.
Thank you so much, Juliana, for that update. So look forward to more. Thank you so much for coming. Now to Asia, where Hong Kong's Hang Seng Index fell around 3% after news that China has imposed fines on heavyweights Tencent and Alibaba. The benchmark index was down as much as 3.3% during the session and closed 2.77% lower at 21,121.2 points, with the Hang Seng Tech Index dropping 3.86%. Mainland China markets traded lower. The Shanghai Composite shed 1.27%, while the Shenzhen Component lost 1.87%. In other parts of the region, the Nikkei 225 in Japan rose as much as 2% and closed 1.11% up at 26,812.3 points, while the Topix index gained 1.44% to close. Australia's S&P and ASX 200 was down 1.14% at 6,602.2 points, and South Korea's indexes seesawed early in Monday's trade, and the Kospi was closed down 0.44% to close. Now, U.S. markets futures dipped in early trade on Monday as Wall Street looked ahead to big company earnings reports and key inflation data on the heels of a strong employment report. Futures tied to the Dow Jones Industrial Average slipped by 201 points. It fell. The S&P 500 was in negative territory, and the Nasdaq was also in negative territory. On Friday, the Dow and S&P finished trading slightly lower, while the Nasdaq Composite rose for a fifth straight day. All of the major averages secured a winning week after a stronger than expected jobs report on Friday that showed that the economic downturn worrying investors has not yet arrived, and added to the positive sentiment. Investors are also looking ahead to key inflation data this week. The June Consumer Price Index will be released on Wednesday and is expected to show headline inflation, including food and energy, rising above May's 8.6% level. After the break, a look at Fitch's downgrade of South Africa's credit rating to near junk status. That conversation right around the corner. Stay with us. Welcome back. Credit ratings agency Fitch Ratings last week warned that debt stabilization in South Africa will remain a challenge as it maintained a stable outlook on the country's sub-investment grade credit rating. The company has affirmed South Africa's long-term foreign currency rating at BB negative, and that's 3 levels into junk status. International financial analyst Dr. Oluwadapo Thomas joins me to discuss this. Dapo, what is the issue Fitch has with South Africa?
We first need to understand the background of what credit ratings are. So credit ratings give a forward-looking assessment of the credit macroeconomic economy, and obviously gives investors an idea of where to invest. So what countries' bonds are you interested in? So when you look at the issue with the outlook, I mean, they brought out the outlook and they said BB negative, and it has stable outlook. You need to try and understand the drivers. So how did they get this assessment? So they've looked at their current fundamentals, their fundamentals being debt. So they believe that South Africa's debt is high and quite unsustainable if it continues going on this path. Ideally, a country's debt is not a problem. The problem is when it comes to debt to GDP, or in fact servicing debt. So if you take debt and you can't repay it, that's where credit ratings come in. The credit ratings is to show how how strong are you to repay your debt. So if you look for context, Nigeria has a credit rating of B. South Africa is BB, which is a better place. The best obviously Switzerland at AAA. So what do this mean? What does this mean? This means that a country has obviously taken debt, and with this current rating, it means that anything can change, and once the outlook changes, it can affect South Africa's performances. But like I said, let's look at the key drivers of it. We're looking at the fundamentals. We're looking at high commodities, which has increased government revenue. We're looking at the fiscal burden of poor public enterprise finances, which is obviously affecting public finances. So at the end of the day, South Africa's government has to assess what they're doing regarding their credit rating.
You're speaking about all these breakdowns and giving all the drivers and the analysis that should be taken into consideration when we're talking about debt to GDP ratios. But what do you think the threshold for government debt to GDP should be?
Well, when you talk about threshold for government debt to GDP, it's people in World Bank usually we say 70% for developed countries, and then emerging companies should have about 60-something percent. But then again, there's a modern money theory that basically has outclassed, or basically has made this rule quite antiquated. Because the truth is, debt to GDP is a concept. It doesn't really reflect on any significance, because if you can service this debt, for example, the country with the highest debt, the United States, $28 trillion worth of debt, but can they repay the debt? Yes, they can repay the debt because they have strong revenues. They can tax anyone in the world, and they also have the strongest currency in the world. So this was, when the former IMF economics, Oliver Blanchard, said, what we should be looking at is interest payments on debt. That's basically what we should be looking at. So can you pay the interest you've made on top of the debt? I think that's the most important driver that affects debt to GDP. But at the moment, South Africa's debt to GDP is about 70-something percent. So when you look at it, it's above what the threshold is for World Bank in terms of emerging economies. However, the question is, can they pay their debts? At the moment, they can, because they are basically a very export-driven economy, and they export commodities. And right now, commodities has to be one of the strongest assets in the financial markets. You have platinum, you have metals, all going for high prices. So at the moment, their revenue is improving. And once your revenue is improving, you can pay the interest on the debt. Then it's not really bad.
So what is, just before I let you go, what is South Africa's current response to this situation, very quickly?
The minister has already addressed it. He said that they are going to obviously adjust their spending, try and reduce their spending, look at their budget deficit and see that, okay, what they are going to spend on in the next few weeks, or in the next few years, obviously we'll have to find a way to improve the returns on GDP. Like I said, if your GDP is growing, you have to, and your debt is growing, your debt has to grow in a level where your GDP is growing. The returns can pay for the interest made on the debt. And obviously you have to look at their position. So they believe that they have a strong monetary policy framework. And with that, obviously, they'll be able to pay their debt.
Thank you so much, Dr. Oluwadapo Thomas, international financial analyst, for sharing your thoughts with us on the program.
Thank you very much.
Now to other stories where the African Development Bank, AFDB, has loaned Senegal 121 million euros to implement an emergency agricultural program. According to the AFDB, the funds will help 850,000 small-scale farmers grow a targeted 38 million tons of additional wheat, corn, rice, soybeans, and other crops over the next 2 years. The loan is a first approved under the bank's $1.5 billion African Emergency Food Production Facility, which seeks to avert a looming food crisis worsened by the war in Ukraine. Now, Nigeria's 10-year Euro bond has closed the first half of the year at a yield of 13.45%, and in terms of unit price, $69.80. Now, this is pointing to one of the worst yields in years for the Africa's largest economy. Sovereign bond yields at double-digit rates are often considered junks, suggesting they are either unsafe to buy or unattractive to bond buyers due to several factors. Now, emerging markets like Nigeria have seen bond prices fall following the Russia-Ukraine war and a decision by the U.S. Federal Reserve to raise rates to combat rising inflation. Now, recent reports indicate about $50 billion have been pulled out of emerging market bonds as borrowing gets harder at a reasonable cost. Now, Egypt plans to launch a low-cost airline called Air France that is scheduled to start operating in the winter of 2022 and 2023. According to the Egyptian government, the launch seeks to stimulate incoming tourism movement to Egypt. Air France, affiliated with national carrier Egypt Air Holdings, will facilitate internal and external flights on the charter system, aiming to provide tickets at competitive prices, whether for citizens or foreigners. By launching the new company, Egypt Air aims to maximize its revenues and increase its profits on the coming years, especially as it incurred large losses during the peak of the coronavirus outbreak. Now, tourism is a major source of foreign currency in Egypt, but it has been affected by the conflict between Russia and Ukraine, as the two countries were important sources of tourists coming into the country. Now, gold was flat in early trade on Monday as the U.S. dollar puts pressure on demand and pinned its near-month lows seen last week. Spot gold held its ground at $1,742.08 per ounce, while U.S. gold futures dipped 0.2% to $1,739.60. The dollar climbed back towards its highest level in about 20 years. Hit on Friday, keeping overseas buyers away from gold. Spot gold fell 0.4% to $19.23 per ounce, and platinum slipped 1.2% to $886.50. Palladium dropped 3% to $2,116.89 after rising nearly 10% on Friday. Now, oil prices were unsteady early on Monday, with Brent trading higher on supply concerns, while West Texas Intermediate WTI dipped as traders balanced supply concerns against worries about a recession or China's COVID-19 curbs hitting demand. Brent crude futures were up 0.1% at $107.13 a barrel, while U.S. WTI crude futures, however, slipped 0.1% to $104.64 a barrel. Trading was thinned by a public holiday in parts of Southeast Asia. Both contracts posted weekly declines last week as the market was dominated by worries that rising interest rates to curb inflation would spark a recession and dent oil demand. And that's it on Business Incorporated. Thank you for watching. I'm Willie Bung. Bye for now.